Welcome to my channel, Balance Sheets Matter. Today we're going to be going over Best Buy stock and do a Best Buy stock analysis. But before we get into that, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos. I'm aiming to get out one per day. So if you like individual stock analysis and want lots of ideas for stocks to buy or potentially value traps to avoid, make sure to subscribe to my channel for that information. And if you do have a stock you would like me to look at, please just leave it in the comments and I might get to it. So let's dive into the stock analysis for Best Buy. Best Buy is a stock I actually really do like. It's right now trading at 12.44 PE with a forward PE of 11.88. So it's trading quite cheap on the PE ratio. So we're going to really have to figure out if this is actually an attractive PE to buy it at, or is this a value trap. Other aspects I just want to go over is for those dividend investors, Best Buy is a nice dividend stock. They have almost a 5% dividend yield with only a payout ratio of 0.62. And on top of that, they're also a big company of buying back shares with a shareholder yield there for the buybacks of 6% and a 3-year average share buyback ratio of 5.3%. So they're returning a lot of capital to shareholders. So let's dive into the financial analysis now. So don't get caught up in these numbers here. They're not basically very accurate, because if we actually scroll down on Best Buy to the revenue, you can see while it goes up and down, it has been relatively flat. And you might wonder, well, why am I investing in basically a company that's not growing the revenue? Isn't that concerning for a retail company like Best Buy? Well, I would say no, because Best Buy basically, they did some big acquisitions, maybe got a little bit too ahead of themselves, and they've heavily scaled down their stores. And this is actually something to understand when it comes to retailers. Sometimes just more and more stores and everything are not better. Sometimes it's better to have less stores and have those stores efficient so you can maintain your margins and still maintain profitable. As you can see, in 2010, they had 1,565 stores. They peaked at 1,779, and now they've lowered it down to 1,138. And even over the last few years, it's been ticking a little bit lower and lower. But I don't actually think this is a concern. I think this is just efficient management by Best Buy. But as you can see, even despite of that, their gross margins have been maintaining very well. So this is the key thing. They're getting rid of redundant stores, and that excess flow of customers is probably either shopping online or going to the main store. So this is a really good sign for Best Buy. Although in the last year, the gross margin, because of the inflation issues and supply chain issues, which everyone was suffering from, has ticked down a little bit. But we're talking maybe 1% here. So this is very minor and not anything that I think is a big concern. So I think the next important factor when looking at any company is you have to look at their interest expense. Because if you have a healthy balance sheet, you're going to have a low interest expense, and that's really good, since more of that top line operating income is going to go to you in the bottom line. And Best Buy has a great balance sheet and extremely low interest expense. You can see in the last year it was only $46 million, the year before that 35, the year before 25, the year before 52, and all these years they're making $1.7 to $3 billion in operating income. So they can afford this interest expense so easily. It's not an issue at all. This is one of the best covered ratios I've seen for interest expense, and I really like where Best Buy is sitting like that. This is one of the reasons I really like the stock, because if interest rates go up, or if they say do actually need to take on some debt at some point, they really have a lot of opportunities and options around that. So we go down to the statement a little bit more, and we can see generally, for the most part, other than these years back here, but remember, they were doing some restructuring back then, they have had positive net income. Although the net income did peak in 2022, maybe because of all the hype of all this buying, it has contracted a little bit. But this does leave them with actually a fairly relatively stable net margin, maybe around higher than 2%, but a little bit mid 2s on the low side, and then high 3s on the higher side. And this was kind of an anomaly year of almost 4.75%. So right now this is probably a pretty realistic average net margin for Best Buy. But even though their net margins are stable and their revenue growth is non-existent, because the revenue's basically been flat almost for the last decade, you can see their EPS per share has just been exploding up. And this is because they are returning a lot of capital to shareholders through share buybacks. Right now, there's only 219 million outstanding shares, and this is a comparison to in 2018 when there was 307 million outstanding shares. So they are doing a lot of share buybacks, and their dividend yield is 5%. This is something I really like about Best Buy, and considering they're a low PE ratio of about 12 right now, they're buying back a lot of shares at relatively really good prices. So with their basically net income they have, their free cash flow, they're able to just really buy back a lot of those shares, large percentages of the company, that grows your EPS and grows your relative dividend yield. So you're getting a good dividend, and rather than getting that revenue growth, they can just buy back the shares to grow your share in the company. So I think this is a very smart thing for Best Buy to do. Don't focus on growing new stores, because that would probably mean less profits and could kill the company. Instead, they did a very good restructuring and they're returning capital to shareholders in a very efficient way. So right now they have 8.3 billion in current assets, and this is a comparison to their total current liabilities of 8.4. This is almost on par, so just a standard current ratio of about 1, a little bit less than 1 technically. But this is because typically Best Buy is using all that excess cash, and rather than keeping on their balance sheet, they're either buying back shares or paying a dividend, which I'm going to show you later. And they basically have total assets of just over 15 billion. There is just under 1.4 billion of that is goodwill. We do have to consider goodwill and typically take it out, since it's not really real in any regard. So when we look at their total liabilities, it's only 12.48 with total stockholder equity of 2.8 billion. We're taking out at least 1.4 of that for goodwill. So they do have a little bit of total stockholder equity, but it's not very much. But I actually think relative to their current market cap, which is 15 billion, 1.4 billion of total equity isn't actually too bad. But you can see now on the cash flow statement, we're first going to start and just see how they're investing their money. Basically, they do this purchase of plant, property, and equipment, which is basically stuff for their stores, physical, tangible assets they need to do. There's these little spotty acquisitions along the way, rather than these big ones. Now it seems they're doing more strategic ones, which make a little bit more sense. But basically, this property, plant, and equipment is just to replace what they're depreciating. So this is pretty standard. Nothing is really out of the ordinary at this point, and it's most likely going to continue at the same ratio of whatever they're depreciating. They're probably having to basically rebuy anyways. So it makes their income statement a pretty accurate income statement, and we don't really have to do any weird adjustments for their depreciation or their capex spend effectively. So we go down a little bit further, and like I was talking about, you can see they're really buying back the shares after this restructuring basically happened. We're looking back at that, and they were starting to get that store count down. They've really been buying back those shares very consistently. Some years it's a little bit less than more, others a little bit higher, but typically whatever they have for their free cash flow, whatever they have left over on their balance sheet, they're repurchasing shares with, and they're also paying a nice little chunk of dividends as well. But if you look at the amount of dividends they're paying, which now it's already gone up to almost $800 million, but in this past between say 2017 and 2020, they're only doing $500 million dividend pay, when their share buybacks are averaging over $1 billion a year. So this actually, the dividend yield you're getting is kind of relatively low compared to the amount of share buybacks they sometimes do, and that's going to grow your dividend yield over time as you own more and more of the company. And you can see on the bottom line, basically solid free cash flow all around. So I basically think Best Buy has a lot of strong points. The one thing is they are a very slow growth company, as in no growth, but I think this is a strategic, smart decision. And because of this, maybe this is why they're getting a little bit of a lower PE, and this allows them to return more like basically capital to shareholders, which I really like. So let's look at the interactive chart here, and I'm going to kind of bring up my relative analysis. We're going to bring up first look at the PE ratio, since Best Buy has had stable net margins over the last while. I think it is a more reasonable thing to look at. We're only going to be looking at more of the recent years, since it's kind of a new company since the kind of restructuring and reduction in the share count there. So let's get rid of the price so we can see this a little bit clearer. And you can see basically Best Buy generally does range it on the high side. It got up to a 20, but a lot of the times they're trading in these low 12s, which is, to be fair, a little bit average right now for that. but this just also speaks to their ability to return capital to shareholders, because whenever their PE is low and they're doing these share buybacks, it's returning a lot of capital to shareholders. So it's not a bad thing that they're staying at this low PE, since when you're a low PE buying back shares, it's kind of actually stimulating your EPS growth even more. So now let's look at the price to sales ratio. And you can see, like I would say, I would want to look at basically maybe, this period going forward, because this is kind of after where the restructuring happened, the new trend is forming, and that share count or the store count reduction happened. So basically you can see the price to sales ratios have been higher. We're sitting a little bit relatively on the lower end. It's potential it could go lower. Like, this is really when I started getting interested in Best Buy back here. So this is an attractive price in my opinion, but there's obviously that opportunity. There could be a little bit more downside in the short term. But this is not one of these companies I'm too concerned about holding, since if it goes lower, the company is still in good condition. They're still able to buy back more shares, return more capital to me, and I'm collecting that dividend in the meantime. So let's pop up the analyst estimates here, the average ones at least, with the revenue with trend. As you can see, effectively flat revenue growth they're expecting, and that may be at least the short-term future, and if it does increase, that's going to be a bullish catalyst. But now we can pop up to basically the EPS, and you can see, well, there was this unusual spike in EPS here. I'm going to get rid of the revenue trend here. The EPS overall does have, since this time here, this very nice slow uptick in price here. So basically in the current year, well, it's expecting to do 6.16, the year after 6.34, and then 6.71. I actually don't know how much this is factoring in the share buybacks currently right now. So it actually could potentially beat quite a bit higher if the company does have excess cash, which they can buy a lot of shares. But even if you're talking in a couple of years, 6.71 basically EPS, that's quite a low PE for Best Buy. So let's take a look at the chart here. This is kind of the new technical trend I would say is forming, and right now you can see I think we are in this undervalued little bit area, but though it does look bad in the short term, Best Buy potentially could push a little bit lower and retest these lows. So, well, you can start buying a position now, because it's sometimes nice holding these dividend stocks to collect the capital. And remember, if you're getting paid a dividend and that's 5% over a year and the stock goes down 5%, you're basically break even still. But I would hold some capital aside, at least that's what I'm doing, to buy the stock potentially if it gets a little bit lower from a technical front. You can also see this is generally where the price volume profile starts appearing. You have the moving averages and kind of the bottom of this pitchfork trend. So I like Best Buy. Tell me your thoughts. I hope you like this basically stock analysis. Remember to subscribe to my channel, like the video, and I'll see you in the next stock analysis video.